Last year, the gold price rose 74%, and silver leapt an amazing 185%. In this week's episode, I thought it was worth exploring what's going on in these markets and considering what we should be doing as investors given this environment. Now, we always have the normal disclaimer at the end of the episode, but for this episode, I think it's just worth also flagging at the top that the information here is general in nature. Everyone's financial circumstances are different, and what's right for one person might not be right for someone else. So please make sure that you talk to your financial planner before you undertake any investments, because of course all investments entail risk. All right, well, thanks for joining us for another Financial Autonomy podcast episode. My name, of course, is Paul Benson, financial planner and practice principal at Guidance Financial Services. Let's dive into this week's episode. Should you be buying precious metals? Okay, let's start with what is driving markets today. A significant driver of the current market unease is political unpredictability, most notably the erratic and often confrontational approach of President Trump. Financial markets hate uncertainty. When leadership appears impulsive rather than rules-based, investors naturally begin to question the durability of the systems that underpin global trade. One example is the US dollar, which has been the global reserve currency for decades. Could that status be under threat? It's especially at risk if the independence of the Federal Reserve is curtailed and they cut interest rates for political reasons, causing inflation to spike. In that environment, it's not hard to understand why assets considered safe havens, things like gold, are attracting renewed interest. As I record this episode, the US and Europe are butting heads on Greenland in an increasingly aggressive way, with trade sanctions being threatened on both sides of the Atlantic. Okay, next, let's have a look at the case for and against precious metals. So we'll start with the case for. The number one reason is it's a perceived store of value. So gold's been used as a medium of exchange and a store of wealth for thousands of years, and that history gives it a psychological status that few other assets can match. During periods of high inflation, currency weakness, political or geopolitical instability, gold often feels safer than paper assets, and that perception alone can drive demand. A second, case for precious metals is diversification benefits. And to me, this is perhaps the strongest one. Gold behaves differently from shares, property, bonds. And in certain periods, particularly during periods of market stress, gold has shown to have either a low or even a negative correlation with growth assets. And just correlation is how one asset behaves to another, and if something has a negative correlation, it means it moves in the opposite direction. So that would suggest that there could be circumstances where, let's say investments, let's say shares, declined. If there's a negative correlation with gold, that would mean that gold would go up. Sometimes you see that with bonds and shares as well. So negative correlation from a risk management point of view can be quite helpful. The only thing, what you don't want though, is when other assets are going really well, you wouldn't necessarily want a negative correlation that's then pulling back your return. So it's a bit of a tricky one that, but from a diversification perspective, nonetheless, gold does seem to have some value there. And so a small allocation can potentially reduce your overall volatility. The third argument put forward as to why an allocation to precious metals makes sense is that there's no reliance on a single government or issuer. So unlike shares or bonds or cash, gold isn't issued by a company. It doesn't rely on a government's promise to pay, and it can't default either. So for investors who are worried about systematic risk, this independence can be appealing. The interesting thing I find about that, though, is that's the main argument for crypto proponents, and yet Bitcoin actually fell in value over the past year. All right, let's talk now about the case against precious metals. The number one is that they just don't produce any income, right? There's no interest, there's no dividends, they don't generate any rent. And that's because there's not anything economically productive happening. So all the returns just come from price appreciation, which I guess is really just a function of scarcity and demand. So they're quite different from business, properties, that sort of stuff that actually generate a cash flow through their very activity. Number two is that long-term returns are pretty mixed. So while gold can perform strongly in certain decades, its long-term real returns are not especially impressive when compared to equity. So there's been extended periods, sometimes 20 years or more, where gold's just gone sideways or in fact even underperformed inflation. And gold has definitely lagged the performance of shares. So I got ChatGPT to do a little bit of number crunching for me, and it estimated that if you held gold for the past 50 years, your return was around about 7%. Now, that's certainly less than you would have received had you invested in stocks or in Australian residential property. Behavioural risks is the other argument against precious metals, in that they often attract investors at exactly the wrong time. It's when fear is high and prices are already elevated, and that certainly seems a highly relevant one today. So people are buying gold because, everything's about to collapse, right? And the challenge with that is usually when you're doing that, you're paying top dollar for it. Emotional entry points tend to lead to pretty poor long-term outcomes. Okay, so let's assume that you've decided that you did want to add some precious metals, and let's probably assume gold because that's what most people would do. Let's assume that you did want to add that to your portfolio somehow or other. How would you go about it? Well, there's really three avenues. One is physical gold, another is exchange-traded funds, or you could be buying mining company shares. So let's have a look at the pros and cons of those. If you go physical bullion, buy the heavy stuff and put it in a safe, the attraction with that is it's a tangible asset. You can hold it, you can see it. No dispute there, which is obviously quite different to something like shares. And there's no counterparty risk. So that is to say, you're not relying on someone else to do the right thing. You hold the gold, you hold it for as long as you like. When you want to sell it, you've just got to find a buyer. Now, the cons, and these are pretty significant cons, you've got to store it somewhere, and that comes with cost. There's also probably the need for insurance, I would think. Liquidity, it's not easy to sell, and you certainly can't sell half of a gold bar. There's also security risks, if you keep it in your home or whatever, maybe you get broken into, right? Also, I'm told, I don't have any personal experience on this, but the buy-sell spreads, if you're going through a dealer, they need to make money, and they've got their own costs in terms of storage and security and those sort of things. So they charge a pretty hefty premium, certainly a lot more than you normally would if you were buying shares and these sort of things. So for investors, physical gold, it's more of a psychological comfort. From a practical perspective, it doesn't make a ton of sense, really. Now, ETFs is another way to go. So the pros there, they're very low cost. They're highly liquid because you can sell small portions, easy to rebalance, and of course you've got no storage issues. The ETF provider is the one that solves that for you. Now, the cons there, it's indirect ownership. There is that counterparty risk element, and you're relying on custodians. So you're relying on the holders to have in the safe what they say they have. For most portfolios, though, ETFs, that's the most efficient way to gain exposure to precious metals. The third avenue is to go mining companies. So perhaps you buy a gold miner, for instance. Important to note, and I've definitely seen this through client portfolios, mining companies definitely don't move one for one with the gold price. I mean, they have a lot of leverage. They have all sorts of business risk. Often there's exploration elements to it. Their mine might be coming towards the end of its life, or maybe they're still drilling and exploring. So you can get circumstances where the gold price goes well, but the gold miner does absolutely nothing. So to me, not a wonderful substitute, but potentially you could go down that route if you wanted to. All right, so again, let's assume that you decided you did want to put some sort of precious metals in your portfolio. Well, how much, what proportion of the portfolio should they make up? Most people would advise somewhere between 2 and 10%. And in my experience, I think even 10% is too high, bearing in mind that this is an asset that doesn't produce any income. So I would suggest between 2 and 5%. The main thing is to think of it as a diversifier. It's definitely not a core holding, right? It's just there as a little bit of protection, a little bit of insurance. And ideally, you would rebalance reasonably regularly, once every year or two. So that when markets are hot, as they have been recently, you might just take some profits there and scale it back a little bit, because there'll be other times where it doesn't do very much at all. Precious metals can be best thought of as a stabilizer of the portfolio. They do provide a bit of hedging against specific risk. And I guess, as I mentioned earlier, they're a diversifier or a supporting actor, right? They're not the main element of your portfolio. They're not going to drive most of your returns. But they might just give a little bit of security, and that might just help in terms of you riding out the normal ups and downs of markets. One reason often cited for going down the path of precious metals is that they're a protection against inflation. Now, that's something that we haven't seen for many decades now, with the advent of independent central banks around at least the democratic world. The authorities have got pretty good at managing inflation, and so inflation's generally been quite low. We had a little bit of a spike after COVID, but for the most part, it's been pretty good. But of course, that hasn't always been the case throughout history, and inflation is harsh for ordinary people, because all of a sudden the savings that you had are not worth what they used to be. You can't buy what you used to be able to buy, it's just really, really destructive for the nation and for the people in that nation. And so frequently gold is cited as a way to protect against that. Now, over the very long period, gold generally has maintained its purchasing power, so there is some basis for that argument, but it's pretty inconsistent. So in the late 1970s, inflation was really high, 7 to 8%, depending on where you were in the world. And over that period, gold did maintain purchasing power, and in fact, it increased in value by more than inflation. So it worked well then. But then from the 90s onwards, for about 2 decades, inflation came down. It was only 2 or 3%, so inflation was much lower, but prices still continued to rise, whereas the gold price actually fell. And so, you lost money in your gold. It didn't maintain purchasing power. It didn't combat inflation at all. So hit and miss there, but certainly this narrative that you buy gold and it'll never go down. It'll at least maintain its purchasing power. It will at least keep up with inflation. It really doesn't hold up to scrutiny, that particular argument. So look, where should we land? Should you be buying precious metals? I mean, everyone's different, of course, as I touched on, but I guess, here's a bit of a way you could think about it. Should it be a core investment in your portfolio? Almost certainly not. Is it there as a long-term wealth builder in your portfolio? Probably not that either. Is it a small diversifier in a well-constructed portfolio? Could be, yeah, possibly. Is it an emotional response to fear and headlines? Probably not either. You'll almost certainly be buying at the top of the market. So, look, precious metals can have a place, but only where they're properly sized, so a relatively small proportion of the portfolio, and integrated into an overall strategy. They're certainly not a substitute for productive assets, sound diversification, or disciplined investing. All right. Well, look, I hope you found that helpful. It's certainly an interesting area in a world and an investment environment at the moment that's got a lot going on, and that's certainly interesting. And precious metals are having their day in the sun just now, so good to explore. All right. Look, you have a wonderful week. I'll be back in a fortnight's time. Of course, Nick will have a Wealth Builder episode out for you next week. But as always, thanks for listening, and do reach out if we can help you at all with your financial planning needs. Bye for now.